Hey everyone, welcome back to the channel. It's Ben Morales here, your personal financial coach. Happy to be back with you today. And what we're going to be doing today is we're actually going to be answering a question that was left on one of the previous videos that I did by one of the viewers to the channel. So before I start with that, I want to say thank you, Ms. K, for putting that question in the comments section. So I hope this is going to make a lot of sense to you. But let's talk about the question that she has. She says that, Dear Ben, I am in Texas. I'm having a hard time finding a credit union that offers a home equity line of credit. They say they only do a fixed rate second mortgage. Is that the same thing? So again, great question. The long and the short of it is they are not the same things. They won't even function the same way. So I want to be able to explain what the difference between a HELOC is and actually a HEAL, right? It's known as a HEAL in the banking industry, which stands for Home Equity Installment Loan. Now we're looking at this everything through the context of cash flow. So remember, when you're doing the rapid payoff method, cash flow is one of the elements that we want to continue to try and improve while we're putting the cash flow into the bucket of the debt tool, which in this case would be a home equity line of credit. So let's find out why they are not the same thing in this case. So in this column, we have the home equity line of credit. And in this column, we have what's called the HEAL. So first of all, the home equity line of credit, it is a line. Okay, keep that in mind. So what it is, a line, when you think about a line, what it is a predetermined amount that the financial institution is going to allow you to use up to that amount for whatever you want, okay, for whatever purpose you want. Now, one of the advantages of that particular line is that the way the interest is calculated is on an average daily basis. So as you're using the line, right, as you're drawing funds from that line, they have to wait to the end of the day to then calculate what money was drawn from it, what payments were made to it, any other fees that may be involved, and then determine what your interest charge was for that particular day. So that's what ADB stands for, is average daily balance. Now, a line can be put on collateral of your home equity in either the first position or the second position. Okay, so in the question she asked, she said that they're telling me all they do is a second mortgage. Basically, that's what this is. A second position is an additional loan or line that is placed on your home. Okay, so I hope that's clear. Now, then moving right along, this is revolving, right? So the fact that it's revolving, what does that mean? It is open, meaning that you can use it every time that you pay it off. You can use it and pay it off. So as the month is going by, you're using your cash flow, putting your cash flow inside this line of credit. And because it's revolving, once the cash flow, which is a payment, posts to that particular account, it then becomes reusable again for you to use. So that's the big difference. That's why it's considered an open line of credit. So let's look at another feature of the home equity line of credit. In some instances, and depending on the institution that you have it with, how they have it set it up, the rate is going to be variable, yes, but they also offer what's called a fixed rate option, which means that as you use that line of credit, you can place a lock on a specific dollar amount, doesn't matter the dollar amount. And typically what that'll do is that'll lock that dollar amount. Let's say you need a repair and the repair is going to be significant. Maybe it's $5,000, $10,000. So you can put a lock on that portion of the home equity line of credit and they'll put a fixed rate on there for you. And then you can just manage your finances to pay that back separately than you would the other portion of the line of credit. So you don't have to have the entirety of that balance, or rather of that loan, against the variable portion of the line of credit. So that's a nice option that a lot of institutions right now are offering. And along with that, in most cases, and this is what's one of the big reasons that makes it so much different than a HEAL, is that it has a draw period, right? And that draw period is typically 10 years. And during the draw period, the bank will allow you to access funds and then pay it back, and access funds and pay it back. So as you're making those payments back, you're getting access to those same funds that you're sending in. And that's how they calculated the average daily balance. That's the line portion of it, okay? So I hope that makes sense in terms of the home equity line of credit. will move over now to a home equity installment loan. And what makes this different than the home equity line of credit? Now, the loan is an amortized loan, which means that when you get a HELO, okay, that HELO is actually going to be placed as a second position mortgage against the equity of your home. So you'll have your mortgage, and then you'll also have your HELO, similar to the home equity line of credit. However, this HELO, because it's a loan, that means it will have a start date and an end date. So I'll use the same example. Let's say you wanted to get the home equity installment loan for that $5,000 or $10,000 repair. They're going to give you a time period of when you start making payments and when those payments will actually finish. The interest will be calculated on an amortized basis, and that's the difference over an average daily balance basis. So this one as well can be put in a first position or in a second position. In both instances, yes, there will be another lien that is placed on your property, on the home equity of your property as well. Now, the big difference is this is closed, right? We talked about with the home equity line of credit is a line. And the advantage to your cash flow there is every time a payment posts, it becomes available for you to use again. Not so the case when it is a home equity installment loan. That is a one-way transaction, similar to your mortgage. You send your money over to your mortgage company. Once it's in that mortgage and it posts, you cannot go back and get that same money that you sent to a mortgage. And I want to make that clear because I know people have made comments about that being misleading. It's not the case. If you send any extra dollars to a mortgage, okay, the only way you get the extra money out from that mortgage is you have to refinance and get a new term for that mortgage or access it through a home equity line of credit. Now, this is another option here, or rather this is another feature, and what makes this so much different than the home equity line of credit, it has a fixed rate, right? The rate similar to the home or the mortgage that you have in the first position, that rate doesn't change over the life of the term that you have that particular loan. So if you do the home equity installment loan for 5 years, it's going to have a 5-year term and it's going to have a specific rate on it, okay? Now, you got to be careful because when they do have fixed rates, you need to talk about, and the same thing, I guess, with the home equity line of credit is, are there any prepayment penalties if you pay the loan off early? So you want to make sure that you ask about that. And then here's typically one of the changes as well, or the difference is the term period. So these are usually over 5, 10, 15 years. Like I mentioned earlier, a lot of home equity lines of credits that are offered by some banks, they will actually give you the ability to do that feature and lock that period in for 5, 10, or 15 years. So I hope that helps you, and I hope that answers the questions for you, Ms. K. So when you're looking for a second position mortgage, if it is a loan, it is not the same as a home equity line of credit. They're going to treat it differently. It's going to be calculated differently. The funds here, once you get this loan, you have to start making payments right away. Not so the case with the home equity line of credit, because it works very similarly to a credit card. You're only charged the interest on an average daily basis based upon what you have used. So again, Ms. K, thanks again for asking a question. I hope this definitely answers your question. And please, I want to invite you all and encourage you to continue to make comments, ask other questions. Let me know what city and state you're in if you're having difficulties as well, and I'll do my research and try to help you out to match you up with the best financial institution for your needs as well. So until the next video, take care and God bless.